Hi, everyone. My name is Georgia Tuvas from Channel Capital. Thank you for joining us today for our first webinar with the CBRE investment management team that we distribute now in the market since December last year, the Global Real Assets Fund. I've got Jeremy Anagnos, CEO of Listed Infrastructure, as well as Justin Pica here with me, who's the portfolio manager in the Global Real Assets team. I just wanted to introduce the strategy. The Global Real Asset Fund is a fund-of-fund structure. It invests in 4 underlying CBRE funds on the listed and unlisted space in property and infrastructure. We've changed it to daily applications and redemptions. It's also offered through a PDS, and available on all the major platforms and recommended by Zenith. So I'll just hand over to Justin right now, and just to give an, overview of CBRE investment management and the global scale and platform that they use, and then go into the hybrid structure and nature of the fund before we get into a bit of a market update and go into outlook and then answer some questions.
Thanks, Georgia. Thanks very much, audience, for your time today, and for Channel for hosting this webinar. I thought I'd very quickly kick off with just introducing the CBRE organisation. Some of you have heard these comments before, but bear with me. I just want to reintroduce to the new audience just around our organisation. So if you think about who CBRE is, I'm sure you're very familiar. It's CBRE Group. It's the full services real assets investment business globally. And from that perspective, Jeremy and I sit within the CBRE investment management business. And from that perspective, if you think about what that is, it's a wholly owned subsidiary of CBRE Group. We're ultimately a leading global real assets investment manager. At the moment, we have about $143 billion US in assets under management, over 30 offices globally, and over 1,000 employees. If you look on the far right of this slide, you'll get a little bit of a description of the strategies or businesses you should understand that sit within the investment management business that Jeremy and I reside. Now, there's 4 key pillars here. There's the private real estate business, there's the private infrastructure business, there's an indirect real estate business, and then there's the listed real assets business. Jeremy and I sit within the listed real assets business. And just before I pass over to Jeremy, I just wanted to say that if you think about the genesis and the creation of the strategy that we're going to talk to you about today, the Global Real Assets Fund, and you'll hear us refer to it as GRAF throughout the presentation, it is largely a compilation of flagship funds that exist within each of those 4 segments that you can see on the far right-hand side. Jeremy?
Thanks, Justin. Yeah, so going back to the history of GRAF, so we're coming up on our 5-year track record. Will hit in April of next year. It was launched in, just after COVID in inception in 2020. And it really was the idea of an investor seeking exposure to a one-stop way of accessing real estate infrastructure, which are complementary asset classes, both in the listed markets and obviously liquidity for investors, but also access to the unlisted markets, and allowing the investor to benefit from some of the unique characteristics that an investor can see in terms of the lower volatility of praised real estate and infrastructure valuations. And really this gets emphasized if we go to the next slide. When you think about an investor who is investing on behalf of a retirement account, and you have your one allocation to listed real estate, and that's been a great investment in the long term, but you do benefit for a portfolio, a mixed asset portfolio, when you add listed infrastructure in terms of both return and risk characteristics. But as you continue to move to the right on this slide, you can see that adding the private solutions or unlisted real estate, unlisted infrastructure continues to enhance the risk-adjusted return opportunity. And then we optimize, in the far right, that solution for what we'll be talking about today. So these assets have contracts or regulation that provides stability of income. These assets have a physical nature to them that provides opportunities for investment and scarcity value. These assets have inflationary aspects to them. So there's a real benefit to having both real estate and infrastructure, and then being able to access both the listed markets, but also the unlisted markets.
Jeremy, I think the benefit for the end client, from our perspective, when we created this fund as well, was really to provide a one-stop solution for the client who potentially is allocating across all of those 4 various investments to different managers. And in the context of this product, we're ultimately trying to deliver a single solution and hopefully an enhanced solution for the client in terms of capability, but also liquidity. Jeremy?
Yeah, that's exactly right, Justin. And so this slide just summarizes what GRAF is and how it represents that one-stop solution. You can see it's 70% targeted in the listed markets, 30% in the unlisted markets. It has a slight tilt towards infrastructure over real estate, but generally balanced exposure to the 2 asset classes. George just talked about some of the characteristics of the fund with one layer of management fees. That's important when we structured this. The liquidity on a daily basis, that investors can access the fund, and then benefiting from just the CBRE as the solution provider. That means you get the holistic views from how we kind of assess both the real estate infrastructure markets, the opportunities. Justin and I and our colleagues on the private side really have an integrated way of communicating. And that's, I think, again, an advantage to this product, as opposed to having multiple managers that may be somewhat at odds in how they are, forming views around the various sectors within each of these markets.
Thanks for that, Jeremy and Justin. So it seems like this fund is a core allocation within an investor's real estate infrastructure sleeve of their portfolios. Do you want to maybe explain a bit how you deal with the other unlisted infrastructure and unlisted property teams in terms of managing redemptions and just getting to that allocation of 70% listed and 30%, and how you monitor that going forward in different market conditions?
Yeah, I'll make a few comments and welcome Justin's input as well here. I think the first comment just really is about CBRE really looks to capitalize on its positioning as a manager across this space, and collaboration and integration are words that we're going to use frequently, but it does come around to communication. And the fact that we created for this fund a real asset allocation committee, where the leaders of each of the sub funds, the 4 funds, participate on a quarterly basis to formally get together and talk about the markets and outlook. That's Lucy Fletcher, the PM for the unlisted real estate fund. That's Stephen Dowd for the unlisted infrastructure fund, Joseph Smith, and myself. We have bands as shown on this slide here to allow for making allocation decisions across both the unlisted and listed markets, to also allow for timing differences between subscriptions and redemptions for the unlisted funds. And I think that's where, again, this product is a bit unique in that we've invested in open-ended funds on the private side. These are scaled real estate and infrastructure funds that have units that we can subscribe to, and we have, that we can redeem, which we have, and that we can transact in the secondary markets, which we have. So the liquidity of the fund is in part based on the liquid investments we have in the listed pieces, but also in our ability to execute transactions to create liquidity or invest on the unlisted funds. And in that open-ended fund structure and having units that can be available for those transactions is, I think, an advantage. And then I'll make one more comment. it's also critical that those open-ended underlying funds themselves have not had any gating or restriction on investor outflows, which we do see somewhat, unfortunately, in the broader real estate and infrastructure fund marketplaces, whether it's in Australia or the US or Europe. But both of these underlying funds not only have not gated in this cycle, they've never gated. So I think that unique positioning of those funds, just adds to the liquidity component that we can speak to.
Jeremy, if I could just chime in there to just emphasize a few points. I mean, look, the first point to note would be you could look at this fund in isolation and say, you're just giving me another fund of funds. The reality is that when you look at this fund and the underlying investments that it has 4 key investments that we're going to talk to you about. All of those key investments or funds are flagship strategies within CBRE Global Investment Management's business. These are critical strategies to our overall business and therefore are critical to be successful. The alignment that this particular fund of GRAF has with those particularly underlying unlisted funds, being the unlisted infrastructure and the unlisted real estate funds, is phenomenal. These funds are inaccessible to, I would say, the retail, wholesale, high net worth market typically. These funds are typically the domain of global sovereigns and institutional pension funds. What we've been able to do with this particular product is ultimately democratize these products, bring them into a liquid, unitized, daily priced format, and bring them to an investment market that otherwise would not have access to these products. The other key takeaway is that there is no feeder fund here. Don't think that the unlisted feeder fund sits there and then feeds through into GRAF. No. GRAF is actually an institutional client of these unlisted funds across the real estate and infrastructure business. And that's critical to know in terms of alignment. And that's, if you, Jeremy's point earlier, if you think about the investment committee that actually overlooks this particular strategy or fund, the investment committee is the leaders of those unlisted funds, plus Jeremy and Joe on the listed side. So the alignment is very, very good for this particular product. Jeremy?
Yeah, that's a great comment, Justin. And I think as we turn forward, maybe a little bit more detail, we'll speak to the underlying funds. And as you noted, the 4 funds, we'll start with real estate. So actually,
I can take that.
I'll put it back to you. Yeah. Have you go through that.
Yeah, look, on the real estate side, I'm going to be brief because there's a lot more information in the pack that I want to get through. But yeah, ultimately, we refer to the strategy on the unlisted real estate side as our global alpha platform. As you can see, the fund is ultimately a core plus strategy. It's an open-ended unlisted fund. It's been around for a long time, since 2010. It's a scale product with over 7 billion in assets under management. It has 44 underlying investments, of which has exposure to over 2,000 assets. It's phenomenally managed. It has been cycle proven over a number of cycles now. And I think the outstanding attributes about this product is it's managing what is, I think, for some of its peers globally, been a very challenging liquidity or illiquidity period, I should say. And this fund, as we speak today, is in a phenomenal position with leverage of around about 32% at the bottom of the real estate cycle, and I believe 7 to 8% cash within its fund as well. So phenomenally positioned. Just turning to the listed real estate or property securities fund that is within this strategy. This is actually one of the longest dated global listed real estate funds in the Australian market. It's actually our flagship strategy in the Australian market. It's been in inception since 2006. It's a predominantly landlord-focused strategy. It is against a rental benchmark, against the typical EPRA developed benchmark. It is focused on outperformance over the medium term, and we've been very pleased with the performance of the strategy and returns. It's delivered over 20% total return on a 1-year rolling basis. The 1, 3, 5-year alpha is around 200 to 300 basis points. And we were blessed to be rewarded with listed fund manager of the year by Lonsec last month. So from a fund perspective, very pleased with the operation. Jeremy?
Yeah, great. I'll cover the two infrastructure funds. On the unlisted infrastructure side, the CBRE Global Infrastructure Fund. This was a fund created in 2019, but the team, managing this, has 2 decades of experience, and this is, a reflection of their long-term track record. This is a uniquely positioned fund that really had I think, an opportunity to start after, let's say, a number of the cycles that had happened. So it doesn't have a lot of the legacy challenges that some funds may have with, say, overexposure to things like airports or, parts of the market that are a little bit more challenged as we went through the COVID period. That fund started small and now has 14 investments, is broadly diversified, but with quite a significant tilt towards the digital infrastructure space, over 50% in digital infrastructure, and a significant portion of that, the vast majority in data centers, which we'll get into a little bit later. So this is some of a unique portfolio with that exposure. Continues to grow in terms of taking on new investor commitments, but again, I think balancing quite well against our well-diversified, on the right-hand side, listed infrastructure fund. This is a reflection of our flagship strategy, which was incepted in March of 2012. Our strategy is broadly diversified across utilities, communication, midstream, and transportation sectors. So it does quite well in terms of alongside the private infrastructure fund, which has that very significant exposure to digital, which is only about 10% of the listed fund. We also have more of a large scale asset, large cap company exposure in the listed fund, where the unlisted fund tends to be, smaller mid-market investments, kind of 200 to 500 million equity checks that they write. So again, good balance of the two fund exposures. Maybe just a quick comment as we move forward, a little bit more detail on the private real estate fund first on Global Alpha. And Justin made a great comment here that this is a fund that would be very challenging for a single investor to just get exposure to. You can't just go in without a $10 million check to get in the door. So giving investors access, just going to have you move the slide forward one, giving investors access to this very large, long track record portfolio, and a bit of its unique positioning, which I'm going to ask Justin to talk to in a second. But I'm going to reemphasize no redemptions no gating this cycle. The team has met every redemption. They were early in selling assets, early in identifying what's been a prolonged cycle. Took a number of quarters of negative valuations, and now have had the start of what we think is a positive valuation story, positive quarter in Q2. This is a fund that's positioned for investment and coming out of this cycle. Talked about the leverage position, the cash position. So this team is looking for those opportunities to invest. But maybe just a bit more about their portfolio positioning and yeah.
Sure. Thanks, Jeremy. That's a good intro. Yeah, so just looking at this slide, and I won't, the portfolio positioning itself, I think, is fairly evident here. There's a heavy weighting to industrial, just shy of 50% there, plus residential is almost 30%. So net, we're talking about almost 80% of the portfolio exposed to industrial and residential. And you might ask, in an unlisted private context, that would take a few years to build up, and how would you arrive at such an allocation? Just to give you a little bit of a lens into the thoughts around actually allocating to these asset classes, Jeremy and I and the entire CBRE investment team are blessed to be backed by a significant research effort and team across both investment management and CBRE Group. And I can, if I had to articulate some of the words of our head of research globally over many years, Jeremy will know this well, it's we like beds and sheds. And that's been a constant theme that we've heard for well over 5 to almost 10 years of investment. And so it's no luck that we have an exposure like this across the Global Alpha Fund. It's definitely a focus that's been research-led, that's been top-down and bottom-up led in terms of taking exposure to some very attractive, high-quality asset classes that frankly have structural tailwinds, particularly industrial, which they've benefited from significantly, and residential, which has been a significant weighting. But also, more importantly, the asset classes that you can see there that they're getting exposure to, which is, multi-market across multiple cities, last mile globally. Also from a multi-family perspective, also a student, a comm and a senior housing perspective. So just trying to capture different layers of the residential thematic, which has been strong for a number of years, not only in local markets, but globally. I think the other point to note would be retail is a lower allocation, as is office. They are both traditional asset classes. And it's worth talking a little bit about office. We will get into it later during the presentation. But in terms of office, if you could see the exposure to office, there is a very decided tilt towards life sciences and medical office, where we're seeing very strong thematics versus traditional office, where we're more cautious, both from a direct perspective, but also a listed perspective. Jeremy?
Yeah, great comments, Justin, on that fund and their positioning. Just on the private infrastructure fund, if we go forward a slide, I've kind of commented a little bit on this. It's a core plus, strategy. I talked about mid-market in terms of the scale of investments. That means they're not going out and competing with the super large asset management groups, GPs, and super large pension funds who have to write, multi-billion-dollar checks to move the needle. And that, positions the team in this fund in an area where they, we think and have been able to demonstrate you can get more attractive returns in the mid-market segment. You don't pay as much up. There's not as much competition. And they have a lot of exposure to some of the asset classes and sectors that people are really trying to get into today. So if we go to the next slide, I mentioned, their digital exposure. You can see that that's of the 4 graphs there at the bottom. The top left is the digital infrastructure. But if you look on the top right, data centers are almost 30% of the portfolio. And, there's a recent announcement with Aussie Super doing a $1.5 billion deal with major data center player. This portfolio already has that exposure. They're not looking to go, they've got, operating assets in the hyperscale space. That new JV that Aussie Super announced is to go invest in new, data center assets, development potential. So I think, the differentiation, we hear a lot about, multiples and pricing for some of those data centers. Question about, is that market, being priced a little bit too aggressively? It certainly is more beneficial to be the owner of existing assets, I think, today than going to have to compete, for the development end. So, pretty excited about their positioning, and allows them to build their portfolio in other parts of the marketplace, where, they don't have to, they've kind of made that investment a few years ago and can now focus on other areas. Rent growth is still very strong for the digital side, so they're benefiting there, but, making investments in other parts of the market. The returns, have been, very strong for the fund since inception.
Great. Oh, sorry about that.
No, go ahead, Georgia. I think we're kind of touching the private funds. Maybe we switch over to the listed.
Yeah, to the listed. So maybe on the listed real estate fund that you're obviously a portfolio manager of. Maybe if you wanted to touch on the office sector as a thematic, and maybe the outlook for that sector, since it's quite topical globally and maybe domestically, and maybe that beds and sheds. So on the listed real estate fund, is it the same high weighting to industrials and residentials, or is it the other way around?
Yeah, just maybe a few quick comments on office, because it's always very topical. Yeah. So from an office perspective, I think the first point to note is globally, I would say from a listed perspective, we remain relatively cautious on office, and hopefully you could also see that flowing through in the allocation on the private real estate side. it's very selective and pointed, and I would say with that on the global side as well. The other point to note on office, which is really important to know, is that from a public listed real estate perspective, from a global perspective, the market has spoken for office, I would say, cycles ago. And the anecdote I want to give you right now is that, for example, our global listed real estate fund has got a 1% exposure to office right now. But if I talk to you about what the index exposure is, it's around about 4%. So office is a very small component of a global listed property fund index as such, and we're underweight that. The other point to note would be is if I took you back to 2010 and said to you, this is what the weight would be for office, traditional office was around about 17%. So the market has spoken for office. It's actually reduced the exposure to it, and new sectors have been introduced to the global listed real estate landscape. So from an office perspective, we are relatively cautious. We continue to see difficult supply-demand dynamics that is being expressed globally in terms of vacancy. We're seeing high vacancy. We're seeing double-digit vacancy across many markets globally. Why are we concerned by that? Well, you would ask me, where would you see pricing power in the market for office? We typically see pricing power for office in the market from landlords when vacancy reduces below 10% and is typically around that 7 to 8% level. In many markets globally, we're not seeing that right now. So while we do think values are troughing out for office globally, and I can talk to you about this on this slide as well when we talk about the listed real estate outlook, we see values bottoming out, but we don't necessarily see a catalyst for fundamentals to improve over the short to medium term, hence our cautious view right now.
That makes sense. And maybe on the listed infrastructure side, on the fund that you're responsible for, Jeremy, if you wanted to just give an, I guess, overview of what sectors are interesting right now. And I know AI is a big theme, especially with demand increasing, but do you think globally they're fully valued data centers, or how long do you think this AI trend is going to last?
Yeah, I think we've talked quite a bit about the data center opportunity, and it's in our listed funds, it's in the private funds. I think we're well positioned in the exposure, but where I think that there's potentially a miss, just not enough information or not being talked about enough, is the way this is going to flow through to the energy markets, because data centers, particularly these AI, generative AI data centers and the hyperscale investments that the large cap tech companies are making, just require an enormous amount of power. And we're talking about power estimates in the US, which, fourfold increase in load demand between now and the end of the decade. Percentage increases, 3 to 4 times of electricity demand, which on top of decarbonization and other things that have been going on, really is going to change the outlook for the investment opportunity set. So if you go to the next slide, we think for the utility sector, and half of our investment space is utilities. This is a opportunity for just accelerating growth, earnings growth. We expect to continue to rise alongside the investment for all of the necessary parts of the grid, as well as the generation that our company is going to undertake. And the U.S. market in particular, which is kind of leading right now in this generative AI development, is predominantly owned by the listed companies. So private companies on the infrastructure market, have very little exposure to the utility sector. So it's predominantly in the listed space that we see this opportunity set. And then if we move forward, just 2 more comments on the listed real asset market. This includes both real estate and infrastructure, but we get people saying, "Oh, did I miss it?" Because we had a very strong September, or July to September, say the third quarter, when the rate cycle shift intensified, and the Fed finally cut rates. Other central banks have continued to cut rates, but that's to show you that it was really just a small blip in terms of the movement in valuations. We are still very cheap relative to equities. We're cheap, versus the history of where we've tended to trade. And at a time when, if you go to the next slide, earnings growth is starting to accelerate versus its long-term average. And this is across real assets, but long-term earnings growth for both real estate and infrastructure, 5.5%. We're forecasting 6.5%, and things just continue to get better. This is all under a secular backdrop of these investment themes driving that earnings pickup. So highly discounted, despite a strong one quarter, really doesn't change the valuation construct that we see, and expect this to be kind of a multi-year performance period for listed real estate and listed infrastructure.
Great. I think I'll just start getting to some of the questions that are coming through on the webinar, and everyone else who's dialed in, feel free to send questions through and we'll try to get through as many as we can now. If not, we'll send you responses after. But there's a question on the impact of interest rates going down and how that will implicate and affect the infrastructure and real estate side of the portfolio. And I know in a lot of client discussions, it seems to be a negative view that it won't be a good thing for infrastructure or real estate, but can you both maybe give your thoughts on your relevant sectors and just your views?
Sure.
If you wanted to start, Justin.
Yeah, I might kick off on real estate, and I might use, it's a nice segue actually to go back to slide 13 of the presentation. If that's okay. Sorry, I'm
That's all right.
I'm asking for the slides to come back up. So I want to talk to the slide, exactly this slide here on the new commercial real estate cycle, because I think that's a good segue into what interest rates potentially mean for the cycle. I guess there's a few messages here that we want to leave with the audience today. The first is that from a listed real estate perspective globally, we believe the market bottomed or troughed in the fourth quarter of 2023. A new business cycle for listed real estate has begun, but it's still early days. From that perspective, we do expect that values have troughed from a listed perspective. From a private real estate perspective, our expectation is, and this is our internal proprietary underwritings on the listed side, we're expecting private real estate values to bottom out sometime in the latter part of 2024, potentially early 25, depending on the asset class and the location. The message here is that's a very traditional cycle. Listed generally troughs out 9 to 12 months prior to a direct cycle, and you'd expect attractive valuations, but it's also the reignition of a growth cycle, which can potentially link in with a slowing in interest rate rises and potentially interest rate falls. I'm not predicting interest rate falls as such, but what I'm saying is that from a cycle perspective, we are expecting some level of interest rate adjustment. We are expecting the cycle to turn positive. We are expecting valuations to move from a discount on the listed real estate side to a premium as earnings grow. The other message I would like to leave you with in the next 12 to 24 months, Jeremy, I'm going to be speaking to you, and we're going to tell you the listed real estate market is trading at a premium to its underlying asset backing. It's actually at a 9% discount today. I want you to expect us to have that conversation with you. The next message is I want you to be extremely comfortable with that conversation, because when we get to a premium, we're going to stay there for a period. The reason we're going to stay there for a period is that we do have growth coming through from a organic perspective, but also an inorganic perspective. We're seeing an acceleration of growth from 2% to 5% in listed real estate. We're also going to see more pricing power in the listed real estate market. And ultimately, when your capital moves to a premium to asset values, you're able to grow externally and issue more capital. So these are very traditional parts of a real estate cycle from a listed perspective. Our message is that you should expect double-digit returns, not just over a 12-month period, which you've enjoyed, but over a longer 3 to 5 year annualized period. And this is a very typical part of a listed real estate cycle right now.
Great. And Jeremy, your thoughts on infrastructure and the impact of rates going down?
Yeah, and I just would tag on to the comments about for real estate. I think it's important to recognize that so 10-year treasury rates in the US are up 60 basis points since the Fed cut rates by 50 basis points last month. It still is a market where having access to capital, favored balance sheets, it matters. I think that's going to be an advantage for the listed REIT market, and it's an advantage for Global Alpha, as we talked about, as a private fund, but in a very capital advantage position. From an infrastructure perspective, I think we have just an incredible amount of capital to spend. We talked about this rising need for the utility and energy space. They keep revising up forecasts. We need stable capital markets, and that to me is favorable if things start to just level off and come down a little bit. I also think that sentiment has been the bigger challenge rather than the actual level of rates. It's been the sentiment of rising rates. When would the Fed cut? So I think we've breached that sentiment, mental hurdle, and should see then, flows and things come back. And certainly as the US market as an example, US utility fund flows just for the utility sector have been positive every month since June. And that's just a signal of the, I think, again, the mental break on interest rates.
Yeah. Jeremy, just another comment on interest rates and also to just catch on your point around balance sheets on the real estate side. I think the key takeaway for interest rates, at least from a listed real estate perspective, is that the listed real estate market has typically always been challenged by interest rates rising in a very quick or sharp manner. And that's what we observed between, call it, 2022 and 2023 particularly. That's generally typically a difficult time for capital intensive asset classes like real estate. I think what we're seeing today is more of a stabilization of interest rates globally. And that's more so the conversation I want to get across today, that listed real estate and frankly listed infrastructure performs exceptionally well when interest rates are stable. They can be high or low, it doesn't matter. If they're low and going lower, great. But from a high interest rate perspective, they're fine. Why? Because the reasons that interest rates are typically high is there's potentially a level of growth in the economy and there's potentially a level of inflation in the economy, which frankly is a good thing for real estate and for infrastructure because they're the perfect conduit for it. It's really just the delta of interest rate changes that is the concern. I feel like we're past that period. The other point on just balance sheets very quickly, just looking at the clock here, is that the REITs are in a phenomenal position of strength right now from a balance sheet perspective globally. Leverage is sitting around the 29% level. They have significant access to capital across the spectrum. If I could give you an anecdote internally that we're watching very closely at the moment, the REITs are accessing significant amounts of debt capital from the unsecured debt markets. They're actually accessing that capital at 150 to 200 basis points spread inside of closed-ended private funds, which is a phenomenal capital advantage that I don't think is well highlighted in the market. So we do think the REITs are in a significant position of strength. And frankly, it is absolutely unprecedented for me to be sitting here today at the bottom of a real estate cycle and be telling you that the listed REIT balance sheets have leverage of 29%. It's a position that it can't be underestimated. So we think they're in a great position to actually grow moving forward.
Great. There's also another question that has come through the webinar. It also comes up a lot in client conversations about the impact of Trump versus Kamala Harris getting in, which is kind of a bit topical, and how that's going to affect positions in the portfolio in different markets. Do you have any views on that, Jeremy? You're based in the US, so you're closer to everything in the action.
You can have this one, Jeremy.
Yeah, in Philadelphia. So we are in the heart of, I think they've both been in the state for a number of days here. Look, I think the outcome for policy for infrastructure generally is positive. It's been an asset class that does well in Democrat or Republicans. We think that best case is whoever wins the White House, as long as there's not kind of a sweep, and the sweep would just mean ability to pass legislation. Both candidates have put forward very aggressive fiscal spending packages that would likely put more pressure on inflation, put perhaps the Fed on pause. So probably best outcome just for markets and outlook for things like inflation, interest rates would be a divided House and White House, Congress and White House. So we don't know which way that's going to go. I do think energy policy either way, just facts for everybody to remember. Under a Democrat president administration, we've pumped more oil in the United States than we ever have in the history of the country. So that's not prevented the whole fossil fuel industry. We built more renewables under the Trump administration in terms of wind and solar than we did in the final 6 years of the Obama administration. So, while there's kind of things that people, focus on, AI is the driver of the economy here in the US in terms of both views on that are very positive. And if power is required, I think it's going to be an all of the above solution. So I don't think energy policy will, at the margin, there'll be some pushback on China imports of all sorts of things, but perhaps things like batteries and other areas that would impact, the renewable market. But I don't think it'll directly impact kind of the opportunity set that we see.
Great. I won't pass on to you, Justin. There's actually a question that's come through on AREITs have been 40% over the last 12 months, whereas global REITs, they've been up only 20%. So how much more value do you think is left in both AREITs and global REITs?
Yeah, look, it's a good question. It's not the first time we've had this question. And I always start off with the comment that I am obviously portfolio manager on both the AREIT and global listed real estate strategy. And I do love both of my children equally, let's be clear here. But from an investment perspective, I do feel actually both AREITs and frankly GREITs have the tailwind of the beginning of a cycle. So both of the returns are going to be, I would say, very similar from a cycle perspective. Both of the groups have accelerating growth from trough levels of valuation. I would say that the attraction to global REITs right now, and that would be my bias right now, is purely not so much from a return perspective, but from an opportunity set perspective. Given the amount of different asset classes or sectors that you can capture from a diversified perspective in a global construct, it's significantly greater than AREITs. And so from that perspective, you do get exposure to significantly greater aspect of next generation sectors in a global asset class or global real estate versus domestic real estate. So from that perspective, the opportunity set to deliver alpha and returns to clients, I think, is greater as it stands today from a global perspective versus AREITs, albeit both of them are going to perform relatively well, I would say, over the next 3 to 5 years.
Great. And one for you, Jeremy. Are you seeing much public to private infrastructure assets being moved in M&A, or has that picked up in the last 12 months or longer, or do you see that being a trend going forward?
That ebbs and flows. I think we certainly have seen a lot of activity of public companies selling portions of their portfolio to the private market. And that the most amount of activity this year has actually happened in the renewable space. Private investors have been amply excited about anything around offshore wind here in the US, big portfolio sales by public utilities, and Ørsted was a big Danish developer of offshore wind. Other portfolio sales happening, onshore wind, onshore solar. There was one private company takeout in Europe, but mostly these have been asset sales. I think we saw this M&A activity a few years ago. It could come back, although I'd say this year we're starting to see more equity issuance and IPO activity in the public market than we've seen in a long time. So there was an IPO of a company in Japan last week, Tokyo Metro. There was a Greek airport IPO earlier this year. National Grid did a $10 billion, the largest ever equity raise in the history of the market back in June. So you know, I don't think we're going to see as much privatization activity. I think we'll continue to see asset sales. That allows the companies to effectively monetize their assets to reinvest for other opportunities, and they're still getting, you know, attractive pricing. So I'd see it more as a good way for them to, you know, use their resources, you know, on the balance sheet side to leverage their future investment opportunities.
Great. And also there's one more question that's come through on AirTrunk, and what you think of that deal in the market and the valuations and how that's shaping your thoughts on data centers right now globally.
You know, I think it is a signal of what we've seen already from players, you know, where a number of the US data center companies were taken private a few years ago. You know, that same player now taking out AirTrunk, with the idea of building a platform. And this very much goes to our view that when you can get a scaled business and platform, there's a premium that the private markets are paying, but they're not paying in the public market. So, you know, some of our core holdings on the listed side, you know, Equinix, which has a very large global platform, you know, just very irreplaceable portfolio positioning. You know, better to own, I think, those operating assets than necessarily going and trying to build a platform that would compete with them. So it only further, you know, in our view, emphasizes the value opportunity in some of the listed companies. And again, for the private portfolio that we have in the infrastructure fund, you know, again, it's an existing operating portfolio. They're not building, you know, assets and are competing in today's capital market environment. And then just last comment, you know, these deals that these to build new data centers on the hyperscale side, it was, you know, 10 megawatt data centers became 100 megawatt, became 500 megawatt, you know, so they're kind of throwing like $1 billion around for each deal. That just becomes very capital intensive. So, you know, something that we want our companies to be very mindful of. So when we do see deals like Equinix is doing, they're doing them in joint ventures. So they're bringing in Prudential as the major equity partner, only committing a small part on their balance sheet, but then leveraging, you know, fees and other ways to drive value. So that's kind of how we appreciate the market's pricing, but would prefer our companies and investments to not have so much risk on the capital market side.
Yeah, if I could put just a finer note on that one, just from a real-time anecdote. So, you know, part of the reason, obviously, why those multiples are being paid for such significant deals is fundamentals are quite good and continuing to exceed expectations. We saw Digital Realty print third quarter numbers just the other night. Stock was up 9% post, and really that's just a function of not only meeting but beating expectations for Q3, coming at the top end guidance, and also an evidence that, you know, fundamentals in that market across particular asset segments and obviously regions are performing quite well. I mean, our expectation is that we should and will see more digital or data center type REITs and investments come to market, and that asset class continue to grow, not only globally but domestically as well. We expect that to occur in Australia.
Yeah, great. Well, that's really interesting, and thank you both for sharing your views on listed infrastructure, listed real estate. Unfortunately, we're out of time, but thank you everyone for dialing in. And if you have any other questions that you wanted to send through, please follow up with your Channel Capital contact. It's just on the last page of this presentation, or go to our website, channelcapital.com.au. Thanks, Jeremy, for your time. Thanks, Justin.
Thanks, Georgia. Thanks very much.
Bye.
Bye-bye.